We're going to discuss what the British government bond story is. Ian Williams, the CEO of Charteris, who manages the City Financial Gilt Fund. Thanks for coming in, Ian. I'm going to forget the past and look to the future, right? So what does this mean for future debt auctions in this country?
I don't think it necessarily carries any implications. I mean, when I was on the show last week, I did say that the market was getting a little bit ahead of itself with regards to quantitative easing. I also said that the 10-year area of the market is actually quite safe at the moment, but there is possibly unrewarded risk in the 40 to 50-year gilts, and I think part of what we saw yesterday was a reflection of that.
Was it a failed auction or not, do you think?
Well, technically, yes.
Technically, but it actually was. It was a failed auction for that part of the market, wasn't it?
Yes. Yes.
But overall, it wasn't really a failure for the gilts market. No expert.
Not really. I mean, go back to January. The head of the DMO was warning that we were, because of the size of the public sector deficit, that we were going to have one or two failed auctions, and there must have been a reasonable bet at the time. It would have been in the 40 to 50-year end of the market. So I think the problem is that the market was paying a little bit too much attention to the mechanics of quantitative easing and not enough to the implications of quantitative easing, longer-term implications, which are potentially very inflationary, which does put a question mark over 40 to 50-year gilts. It's conventional gilts.
I think going forward as well, I mean, the bond market's clearly worried about inflation in the medium term.
Yes, I think it is.
It is, right? So how about the word deflation? Is that relevant to the bond market and your investment policy?
I think really, to be honest, deflation was yesterday's story. I think there was a time when deflation loomed large on the agenda. I think quantitative easing is the authorities' response to deflation, and I think if they're prepared to print enough money, they will win over the head off deflation.
If there's a lot of blame culture going around, someone's blaming Gordon Brown, DMO's blaming Mervyn King, is the blame culture really helpful at all?
Not really, no. I mean, the basic core problem with the UK faces is it's got a massive government borrowing requirement, and that's got to be somehow covered between what the government spends and what the government raises in taxes. And at the moment, there's a balance between issuing gilts to investors, which is the orthodox way of financing the government deficit, or effectively issuing gilts indirectly to the Bank of England, which is quantitative easing, which is effectively printing money to pay that, monetising the deficit to pay for that part of it. And there's a balance between the two, and that's what's going on at the moment. And it doesn't really help for one arm to blame another arm. I mean, the root cause is the amount of debt they've got to sell.
In October last year, if not earlier, people were saying get into government bonds as soon as possible. The long-dated gilt or bond, if you like, the returns have been quite weak.
Absolutely, yeah.
Now, what are you advising your clients? I mean, what do you say is the best value right now, looking down the line?
Well, we switched. The fund I ran actually switched in November for the first time ever since the issuance of index-linked gilts in 1981. In certain bits of the curve, you could actually switch conventional gilts into index-linked gilts on level yields, which has never been seen before. So we took advantage of that. So we switched a big chunk of the fund into index-linked gilts, and there they remain today. So we've got.
What's your return because of that?
Well, our return's up this year. I mean, our fund is up, 2 or 3%, when most of the other funds are down. And that includes corporate bond funds as well, which are basically tied to the conventional gilt market. So we still think index-linked gilts on 1.5% real yields offer better value than conventional gilts on, say, 3 or 3.5% nominal yields. Because if you look back, say, over the last 10 years, or even since they were issued, when index-linked gilts were issued in 1981, they were issued on real yields at 2%, when conventional gilts at the time were on 11% nominal yields. Now, the index-linked gilts are still on 1.5% real yields. Well, in this sort of environment, if quantitative easing does lead to inflation a year or two down the road, 1.5% real yield isn't actually a bad bet. 3%, 3.5%, 4% nominal yields, a bit more questionable.
What do you want to see the Bank of England do now? Is the easing enough? Is it what you want to see, or is there a different tool in the box that they should be using?
Well, to turn the economy round, they're probably going to have to print quite a bit more money, I would suspect. I mean, quantitative easing will work, in my estimation, if they're prepared to do enough of it. I don't think they've done enough so far. But also, you've got to allow time for it to work. I mean, you can't just start quantitative easing on Tuesday and expect...
How much time? Yeah, kind of interest.
Normal lag on monetary policy is 6 months. So 6, maybe 9 months.
Throwing easing into that for packages.
Well. Yeah, and other governments are doing it as well. I mean, all around the world, governments are undertaking quantitative easing. I mean, they're undertaking quantitative easing to directly offset deflation. And what you effectively do is manufacture inflation to offset the deflation. And if they're prepared to do enough of it, it should work.
How does the sterling weakness factor into all this? I mean, how much of a worry should the UK investor be about that?
I think if the UK was adopting quantitative easing on its own, then obviously sterling would be up there as a target.
I mean, there it is, 146 right now.
Yeah. But other countries are doing quantitative easing as well, so net, it probably balances out as a neutral factor. It would be far more worrisome if the UK was doing quantitative easing in isolation, but it's not, so you have to just offset it one against another. I mean, you could argue it's bearish for the dollar if the Americans are doing quantitative.
So final question, all the packages coming in, Tim Geithner's, Gordon Brown's, etc., Darling's, the easing, the rate cutting, in 6 months' time it should be all joy.
Well, that's effectively what the equity markets start to tell you. The equity markets start to move up in anticipation of maybe slightly better times ahead.
Thank you very much for joining me. Ian Williams there from Charteris CEO, indeed, coming in.
Hear more Bloomberg News reports on the Bloomberg Terminal at AV Go, on Bloomberg Television, and on Bloomberg Radio. Copyright Bloomberg LP 2008.